You're watching CapitalCosm. My name is Danny. It is January 1st, 2025, and my guest today is Eric Yeung. We'll also have Francis Hunt joining us here in a bit, but we're going to kick it off with you, Eric. Happy New Year, first of all, and what a year we've seen in silver. I want to pull up a chart here on the yearly close of silver just to kind of exemplify the year we've had, and here it is. Silver closing out the year at $71. This is the 1-year candlestick, and we haven't seen a 1-year performance, a 1-year candlestick of this size since 1979. So this is 45 plus years in the making here. What are you? I mean, Eric, where are you looking ahead when it comes to the silver market? I'm hearing like these people on Twitter talking about how the top is in and $85, $84 was a parabolic run. But I'm looking at this cup and handle pattern. This has been forming for 40 plus years. And to tell me that it's all just leading up to this one green candlestick, I just can't believe it, because one way to project out is to go from the bottom to the top of the cup. And if you extrapolate out, I mean, that takes you well above where we are today, at the very minimum, $200 silver. So, and then also you also have this pattern, this trend line that's been forming since the 1800s too. So this is not just generational. This is like once in a century type move, it would seem.
Yeah, well, first of all, Danny, Happy New Year to you and your audience. And second, when in terms of silver, right? Let's step back a bit. Since the first time I came onto your show, I think we spent a lot of time talking about how China, Russia, and the rest of like the BRICS countries and the global South, they are not really aggressively recycling their US dollar trade surplus into US Treasury bonds, notes, and bills anymore, right? I mean, it's the writing is on the wall. I mean, I'm not going to spend half an hour talking about the details of how they're doing it, because everybody else is talking about it. Okay, so they are either like I'm being generous when I say that they are not aggressively recycling. As a matter of fact, I think they are simply trying not to recycle as much as possible. Okay, and whatever trade surplus they have into U.S. debt, because that, like, what is that? That finances the U.S. government. And the U.S. government, its debt is going parabolic, right? And the U.S. government is trying to contain the rise of China, Russia, and the rest of these BRICS countries. And I mean, these are all facts. So, the fact that these BRICS countries, China, Russia, they either no longer recycling the trade surplus into U.S. Treasury bills, notes, and bonds, or the other ones, the other BRICS countries, they're beginning to do so. Now, if we take that as our basis, then why would Uncle Sam, or any Western country for that matter, continue to work with, let's say, China to suppress the price of a critical mineral such as silver?
Why would they? Yeah.
Why would they? Because that's part of the deal, right? Like, I mean, China is the world's factory, and the deal is that China recycles, like I said, trade surplus into U.S. debt, and then the U.S. suppress, working with China suppress the price of commodities so that China can make cheap products to be shipped to the U.S. and the West. So I don't see that continuing. That's really my premise. I don't see that continuing. And what I see now is that all countries, like, I mean, you look at India, Russia, the Middle East, South Korea is a major manufacturing powerhouse. Their proxy is Samsung. They're all rushing to get their hands on physical silver. So I think that's the phase that we're in now. And starting today, January 1st, China is implementing a physical silver export control, limitation, restriction, however you call it, on a case-by-case basis.
Yeah, and we've also got multiple prices of the price of silver right now. We've got the COMEX price a little north of $70. We've got the Shanghai price around $85. We've even got Middle Eastern prices in Dubai that are even above that. So it looks like all of these paper prices, they're all going their separate ways. And it seems that it's only a matter of time with this great repricing that's ongoing today with silver, and most likely pretty soon with all the other commodities too, that you'll have two separate markets. You have the paper price, and you'll have the physical price, because this isn't 1980s. This isn't 2010 and 11. There's huge industrial demand following silver this time around, and they've got to get physical delivery, and then the physical price is really all that's going to matter. So, do you see the paper price becoming more and more irrelevant from this point forward?
Let me read something to you. I just received a notification from one of my mainland Chinese followers, and he has, access to breaking news. Basically, we are all trying to authenticate this news, but since we are in the middle of a holiday, it's sort of difficult. But I'm going to read it to you. Okay? Your viewers can listen to this and determine what they want to believe themselves. So, official confirmation from the Shanghai Port Authority. As of 11:47 p.m. local time on December 31st, Chinese ports have begun refusing to ship silver cargoes to delivery warehouses approved by the COMEX, the New York Mercantile Exchange. The U.S. proposal was extremely straightforward. Urgent purchase of 50 million troy ounces of silver, immediately obtain export permits, pay with U.S. Treasury bonds, and bypass the SWIFT system through bilateral currency swaps. Beijing rejected it. So isn't that that's some crazy stuff going on, if it's true.
Yeah.
I just sent you the link to the letter. You can, the breaking news. You can put it up for your audience. Do you see it?
Yep. Give me 2 seconds. Let me share it. I see we have Francis now on the panel. Francis, thanks for coming on.
Hey, glad to be with you guys. Happy New Year.
Happy New Year, Francis. So we're going to read this breaking news from Eric. So official confirmation from the Shanghai port. So yeah, this is essentially what you just wrote, right?
Yep.
Then
there's another one. I'll give you, but you can leave this one on. There's another one. This is crazy stuff that I tell you, my entire professional career, I made millions of dollars from this, okay? I was in the business of the contract manufacturing in China and export of China. That's all I did for my entire adult life and my entire professional career. And I did pretty well. Over the years, I made, like I said, millions of dollars from this. And I tell you guys, and Francis, I know Francis has a lot of life experience. So Francis can tell me if this makes sense. I tell you guys, every single time in the past, when the Chinese government implements some sort of export control or some sort of restrictions on exporting certain items out of China, I get a flood of phone calls from the people I work with, like the export brokers, the customs brokers, whoever. They tell me, Eric, don't worry about it. It's a nothing burger. There's nothing to worry about. And I tell you guys, over 2 decades of me in this business, It is never a nothing burger. Never. Not once. And it is my conclusion that whoever believes this to be a nothing burger, if they just listen to some mainstream Western media or some random broker, I really have to question their IQ. I don't know. I mean, like, it's either some malicious intent or this particular person has pretty low IQ to believe in that. That's it.
No, I mean, you're seeing so much smoke that there's got to be fired. I mean, they're raising the margin requirements. They're doing overnight repo purchases just north of $30 billion. And some of these people on Twitter will tell me that, oh, this is just a year-end window dressing. But hold on a second. If I look at this repo chart, overnight repo chart, I mean, this is where we're at today, 31.5 billion as of the end of December. This is supposedly year-end window dressing, but this chart goes back to 2000. And the only time this happens is it's happened right before 2020, before the big COVID scare. It happened right before 2008. And it happened right before 2000, the dot-com bust. So am I missing something here? I mean, we've got so many signals here pointing us in the same direction that you've got to triangulate it to that conclusion. I'll start off with Francis, since I haven't heard his prognosis here, Francis. First of all, Happy New Year. Thanks for coming on. What do you make of this? We closed out silver the year at $71 or so. And I also want to point out another chart Eric's talking that supplements what Eric just said about U.S. bonds. And I think they did break something in the bond market. We've got two different charts here. The white chart is your 10-year yield, and the green chart is your copper to gold ratio. And as you'll notice that the copper to gold ratio tracked the 10-year yield fairly precisely up until 2022. That was the start of the Ukraine war, and once we started sanctioning Russia. At that point, the 10-year yield stopped moving in conjunction with the copper to gold ratio. My theory is that when the copper to gold ratio goes down, that means gold is outperforming copper. Gold's getting a bid. It's outperforming copper in such a way that Dr. Copper, the economic metal, the industrial metal, can't keep up with it. And so, and that's in that type of scenario, people also flee into U.S. debt. But it's not happening this time around. As you can see, the 10-year yield's up. So they've lost control of the 10-year yield. Foreign investors are not piling into the 10-year yield in this condition as they have at most other times in history. So I know this is a long-winded question, Francis, but what in 2025 and what in 2026 do you see so far laying ahead for the path of silver? Because I hear so many people calling for tops and all this other stuff, but this thing has been like building a cup and handle pattern for 40 plus years now. You can also draw a trend line from the 1800s up until today, connecting today's price to that. So this is not just like an event that happens once every 10 to 20 years. This seems like there's something greater afoot here.
Yeah, let me comment on your chart. First of all, yeah, great to see Eric and yourself on the first of the new year, and welcome and hi to everybody watching. The one comment I'll make on your chart is that I see a lot of these correlations and everyone's saying these correlations are breaking down. You've got copper there, and you've also got the 10-year treasury, for example.
Copper to gold.
Yes, so. Copper to gold, the copper to gold ratio. And here's how you deal with this particular one. And there are others that people can use. I've seen people mention the copper to gold before. You're in a particularly unique economic environment. And what we have is our model of hyperstagflation. You have pivoted into a preservation of capital epoch in a very weak economy. So one is an industrial metal, which is required particularly in construction and in energy consuming growth environments, which is the stagnation canary tweeting. And the same works for oil. We're behind the oil short gold long of 2 years ago when it was initially gold moving, which you could have pivoted into a silver long once the gold silver ratio changed as well. All these things are showing you that actually investment into construction and growth environment is not actually there. And the preservation of capital is there. So this is why we've said, don't be rushing into oil stocks, don't be rushing into construction stocks, don't be overly aggressive in everything. The first and foremost part of this correction, the first movers and the biggest movers will be your monetary metals, not other commodities. Because of the debasement of currency, in the end, all these other things are going up, and I've shown beef charts and coffee charts and everything else. That's not to say there aren't going to be some good trades to be had in there. But particularly when you start talking about stocks, I saw JP Morgan and other investment banks trying to make a massive case for ExxonMobil. And then at the same time, Goldman Sachs and others are saying oil could actually drop to $20 and $30. So, you know, and I saw multiple in my trade blotters. The news articles that are all put up were ExxonMobil ridiculously cheap. So I was seeing all this thing mobile, and I'm like, no, guys, this is the preservation. I call it the rotation to preservation. The rotation trade now is out of all forms of risk assets, particularly debt markets. So the original chart you were showing me was the yield. Yields go up when price goes down. Everybody is quietly leaving the room. It's become a very uncool party to be at, the party for the bond guys. Everybody wants to leave early. They're slipping through the door. They're doing their, I showed up, thank you. You know, I get the tick in the box. Oh, is that the time? I really must go. And slipping away for the door. The gold party is an absolute pumping party. Those guys are still celebrating New Year. And the music's just beginning and the dancing girls are just showing up. And that's where we are right here. Capital preservation, the rotation to preservation, and the debasement of debt and fiat. And as a result, in the end, oil will eventually turn in dollars because the fiat debasement will be so chronic. But particularly in the case of oil, less so in the case of copper, they are trying to mask the next lie as propagandists, and oil is a captured market. And this ties in with Trump and Venezuela and a lot else. And we've called oil many times. It's ironically, technically, without knowing a massive amount about the oil industry, I can't say I've worked on rigs, I can't say I've overly studied it. 2 or 3 times we've called massive sell-offs in oil and surges in it. So for some or other reason, we're quite accurate in it, but it's because of our understanding it's a Rockefeller tax. When everybody was getting liquidity and it was a go-go market, and everyone was releasing money on their property to buy a second car after not even 2 years, because there were mass affluence on property markets. This is 2006, 2007, 2008. Well, just before 2008, the oil price was ratcheted up and they skim more from you because you flush. Then when we get a massive, devastating recession or they shut down, oil price is allowed to absolutely collapse. They are trying to mask the inflation. They lied on the labor stats. They're lying now on the inflation. You need to be a curve ahead. You shouldn't be saying, yeah, it's all about the recession. We were talking about the fact we're in a recession the last 3 years. In fact, even back to 22. Is that 3 years or 4 years now? All because that was the current lie. We were seeing the slowdown. And that meant you got a little bit of cuts in the interest rates, but actually not very much. Now we're going to go back into the inflation era and the interest rates are going to keep moving. 2026, one of our core predictions is 6 by 6 by 6. 6 of the major G7, G8 nations on their long ends are going to be in the 5.75 to 6% range. And I'm including Japan in that, shockingly, whose inflation rate is now higher than America, and his rates are starting to move very much to meet that. So this is all the debt debasement. And the only place you want to be hiding when you are dealing in digital, imaginary, created debt that is unbacked and fiat that dies with it. Remember, fiat and debt are the same thing. One just is at a timeline with a rental agreement attached to it. When those things are going down, inflation climbs. And everybody knows the one thing that preserves value empirically and is demanded greatly is gold and is hopelessly underheld. And of course, silver, which has benefited from not only the debasement, the 70% gold performance, but its extra performance, which is sitting at 130, 140%, that extra 60-70% is on the drivers that Erica was just describing earlier. Here you have something that is industrially consumed, a monetary metal, and everybody doesn't trust that people hold it anymore. So you actually have physical demand and supply issues. And that's economics 101, the supply and demand curve. And the minute people say you don't have it if you don't hold it, and people stop letting things flow out their country, as Eric's been describing, or control it far more tightly. I think there's only 44 registered places that can actually allow silver to leave China now, and they're all registered, and China can just go, okay, no, and they'll all stop because they'll lose their licenses. You've got that additional gift, which makes silver additionally attractive. That's the kind of the fundamentals. Then if we get to the technicals, I've shown the chart so many times, and I'm happy to show it again. But for us, the silver trade started, and I'm going to put the all-seeing eyes for the closer screen, even in 64. The run-up from 64 to 80. So we are sitting here in 2026. You're talking about 40 years and another 22. Another 26 years. You're talking about going on a 70-year event. And this started with the Vietnam War and America and the proliferation and the absolute gouge that they were doing on the military industrial complex. And what happened is we were still on a fixed gold standard there, and everything that has transpired since then has been as a result of loss of confidence. So we're in terms of the 70s, one thing that was common, and I think people over-associate today with the 70s, it's much worse. The debt to percentage to GDP are significantly higher. Everything is significantly worse. It is a hyper-stagflation, as we've described. But the one thing that is similar is that there was a loss of trust in America. Same nation. It was actually the European nations. It started with France. But this is even more different in that the whole Western nation has been dragged into lying and playing the same fiat game. So we have an entire hemisphere playing as America. It is primarily America. They're the hegemon, but it's not the only one. So everybody else is synchronized to become a leper in that leper colony. And the technicals are extreme. And that's your setup. And then there was the Brent Johnson entry, which was on the primer over there, when he said all the silver guys are going to go lose their heads as we get the annual pilgrimage to 25. That was our 25.9 break. And that is go down in internet fame, like Gordon Brown's bottom on gold in $257 odd. But since then, you've been in this absolute breakout. If you look and you keep watching on the big time frames as an investor, what is that? That is a tiny little wick pushback on an absolute ripping break. It is a tiny little pushback on an absolute ripping break on its journey to do incredible things. And can I also add fundamentally what happened? 2 increases in margin taking you from 20 to 25, and then from 25 to 32.5. So they're going to probably flush out a bunch of retail traders that were sitting with excess leverage to the long side, and that might be part and parcel of whatever pullback you got. This goes higher, providing you patience. How long? I would have to drop to the lower time frames. But I've said a lot. Let me hand back to you.
Yeah, the margin thing is really interesting, and I'll pass it over to Eric because I know you probably need to go soon, Eric. But in regards to the margin stuff, they not only raised margins once, but twice now. Doesn't this imply that
Panic.
They underestimated the buying pressure coming from silver? Because if they had to only, if they were to raise margins, why would they not raise margins in one go? Why would they not raise them to the levels that they wanted to in one go and just flush out all the leverage longs? It seems like they raised them the first time, and it produced some flushing out, but then we quickly saw the price retreat up to $77 the following day. So it worked effectively as more of a speed bump than a permanent fixture here. And then they raised them again. So this kind of signals that they're going to the well one too many times, and now they're back down to 71. Can they just keep raising? I mean, doesn't the raising of margins kind of lose its potency, after you do it so many times? And isn't this another sign of desperation here? Or do they just want to keep the price low for their buddies on Wall Street to buy long on Monday? They don't want the price to get too out of control. Could that be another option?
Okay, well, I think in the case of China, right? Because it's kind of like almost like a coordinated situation because China did the same thing on the same day, raising margin requirements at the SHFE, which is China's Shanghai Futures Exchange for silver. Okay, so China did it on the same day. But in the case of China, I think it's healthy because what it did was it just flushed out all the leverage speculative longs. So now the system is reset, and we're back to being driven primarily by the physical market. So physical silver demand in China via the SGE, which is the Shanghai Gold Exchange, silver contracts. Now, in terms of the COMEX, which yourself, Danny and Francis, you guys talked about, it's funny because when I saw that, I made a comment. I said 30% is almost like a cash market. So they should just take it to 100 and make it a cash market. But in my opinion, by the way, guys, if they take it to 50, which is possible, okay? Like they take 30 to 50. 50% margin requirements is pretty much a cash market. You know where I've seen that? In Hong Kong. Okay. In Hong Kong, when they try to curb speculation in the property market, they CK Leung, who was our chief executive at the time, raised the I'm just going to simplify the mortgage margin requirements, basically. Okay, it's like your minimum down payment to a luxury property. I think luxury property in Hong Kong is like around $2-3 million US. That's their definition. Okay, so you have to have 50% of the cash upfront to to buy those properties. You can borrow the other 50 from the bank, but you need 50% upfront. And that really stabilized the Hong Kong real estate market. And at that point on, all the transactions were, in my opinion, very close to cash deals. Okay, so this can potentially happen at the COMEX. They take it to 50. But let me ask you guys one question. What if they take it to 50 and the price of silver still goes beyond 100? What does that tell us? In my opinion, that tells us that, whatever we're seeing in terms of the rise of silver prices internationally is driven primarily by physical demand, not speculative money.
And that's what we were kind of getting to at the start of the show, is that we are starting to see the bifurcation of two separate markets, a physical price and a paper price. And if the paper price is no longer representing the physical price of silver, because that's essentially what the paper price ought to do. It's a representation of the physical price. But if it becomes less meaningful to the physical price, then it just drops into irrelevancy.
I'll give you a crazy number. Okay, how about this before I leave? In 2020, when silver spiked up to $30, around 30, okay, the number of open interest at the COMEX for silver futures was at 80,000. Sorry, hold on. Let me just make sure. 800,000 contracts. We are now at 480,000 contracts, approximately. So, we're now down what? Almost a third, more than a third of the open interest. So there's no speculative bubble. It looks like, as a matter of fact, my followers, some of them have done a lot of research on COMEX numbers. They follow it day by day because you have the COT reports, you have the issues and stops reports, and you can actually check the COMEX data on the CME website on a daily basis, right? I don't have time for that, but these guys do. Bob, the Bullion guy, great guy, comes to me and tell me that basically, it's most likely that these bullion banks are covering. They're like, taking advantage of that paper slam just before the holidays to cover the short positions. So that's what I see here, Danny.
Yeah, I mean, it wouldn't surprise me. I want to show you
Yeah.
this chart here before you head out, Eric, and to kind of rebut some of these people calling for a top in silver. And so this is just a regular chart of gold. Goes back to 2009. You see it's formed a cup and handle here, and we are where we are. Now, I want to take this cup and handle pattern and overlay it on the larger 40-year cup and handle pattern on silver. And so when I do that, it's actually a pretty decent fit. As you can see, it's the blue line here on top of silver. And just to kind of extrapolate up, I mean, you're looking at $500 plus silver if it follows that pattern. So, for all these people calling for tops on silver and all this other nonsense, this is decades in the making, folks. So just my opinion here, but you see it in the technical patterns of previous cup and handles, ones that come from gold. So, Eric, do you need to run?
Yeah, I'm just gonna say one last thing. Happy New Year, Francis. I didn't have a chance to say that to you when you hopped on, and I also want to say, just remind everybody, the audience, that Francis called out for the Silver Lady. That's what he called Silver Lady, the lucky Silver Lady at $40, around $40. I mean, that's like great call, Francis. I mean, $40 now is almost 80. That's almost double in a couple months. So congratulations, Francis. You made a very brilliant call on the price of silver.
He did, yeah.
In the last couple months. Yes.
Thank you, but I wasn't the only one, and you've consistently been providing the breaking news yourself on the real fundamentals that none of us here out in the West have, and your news feed from out East has been invaluable too. So I think you can take a bow for your service to society in terms of sound money and keeping them on the train, which is the great journey that really has just begun, not ended. So yeah, Happy New Year back to you, and thank you for your work to everybody else as well. And to Danny, of course, too, but we'll hang him out for a bit longer.
Oh, I pale in comparison to Eric. I mean, Eric, you're providing a public service with all this intel and data.
Yes. And can I come in on the comment? And I mean, if Eric stays or he goes, that's up to him, he can. About 15 years ago, when investigating and discussing gold, how it goes, and the paper price, I came up with it's a new speculation, and I don't think I'm the only one, so let's just de-egoize that statement, sorry. I discussed a two-tier pricing system, that one will be based actually on delivery and one will become paper, and that is a transition phase to where you may as well go straight to the only price that now matters is the physical delivery one. There is this interim phase where they have this sort of two-tier system. It's a passing of the baton. But if you think anything through, the people that are taking the higher percentage of delivery on their exchange are the market price. And this is not only a fundamental fact, it's also a technical analysis fact. Markets with no volume of actual delivery are not well-validated prices. Markets with high volume are considered validated prices. So even in technical analysis, you go where the delivery goes, and that they will merge. And such was the discussion. I mean, I've scenario cast. It was quite funny to have Cliff High call me out as some sort of noob in the precious metals market, as a guy who was born on the biggest gold mines in the world, 2 miles deep, and heard about sound money in the early 80s from a Liberty Life saying how the dollar will eventually go bust. The sound money is something, as someone who was on, always subscribed to GATA from the early days when, Jim Sinclair was around. It was quite funny. But, to anybody else, people are getting territorial about their call. When people start arguing about who did and said what, it's all about the egos now. But I can say I even referenced the
Francis? think we lost Francis. All right. Well, Eric, if you need to hop off, feel free to do so, my friend. But tell us where we can find you for people that are interested.
People can. Yeah, well, thanks, Danny. People can find me at King Kong 9888 on X, and they can find me via the same address on Red Note in
Real
China
price that
if they wish to.
The real price is far higher.
Hey, Francis, you cut out for like a minute there.
Sorry, let me go again.
Yeah, 1 second. Eric has to go here, so he wants to shout out his socials. Eric, go ahead.
Okay. King Kong 9888 on both Red Note and X. And thank you guys for this opportunity to join you guys on January 1st, 2026. It's a really special New Year day for me. I've never done this on the first of the year, and I really enjoyed it. So thank you guys. God bless yourselves and your families, and good luck to everybody in 2026.
God bless, Eric. Happy New Year, my friend. We'll do it again soon.
Thank you.
So yeah, Francis, go ahead. You were caught.
So
your connection cut off.
we already gamified how they'll go about this change. We've been talking about the fact that the Western pricing. So here's all the points to be dropped, because one of your questions, and I think it pulls a lot of the interview questions all together, because you were joining on the and doing a very good job, I must add. You were pointing out the repo drawdowns for banks probably could be short bullion. We can speculate. It could be other reasons, by the way. They've got underperforming loans as well. It doesn't mean we have to be accurate, but silver could certainly be part of that mix. I want to take you back to some of the older, well-established facts. The facts like if you had put a bot on trading the open in the East on gold and closing at the close. This has been, and I was showing this chart on YouTube. I started the channel 2009. Thank you for all those that have chosen to subscribe with us as well. We finally made 100K. The algo doesn't always love us so big. But anyway, right early then, we were showing the three charts, the actual gold chart and the split chart. And we have been living, you can't say you've been taken by surprise of this. We have been living since the 70s with a transfer mechanism. You've already had two prices. We discussed this many, many times in previous YouTubes on our channel, that you were in an absolute parabola on the Eastern Open and you're in an absolute loss, amazingly, despite gold's upward move. If you bought the open on the London Open and the Western Open and you closed on the New York close, you're in a compounding loss. But the parabola that was the Eastern Open was so much more dominant that you get the actual gold charts that we have, which is the intermediation of both lines. This was quite clear that we've been running a multi-decade, and I mean multi-decade back to this, we're talking 70s here, a multi-decade discount window in the West for the transfer of gold from the West to the East. And this isn't a new phenomenon, because I know how long I've been talking about it, and I'm not the first, and other people have referenced it too. So that's point number one. There's a discount mechanism. We said eventually you get to the point where money, it becomes a gambler's price. It's a casino number in the West, and you actually have a delivery market, which is the real market. Everybody knows you go to Scottsdale's Mint, if you're an American and you want to buy an Eagle, you ain't paying spot for that. And if there's a delivery charge or whatever, so your actual acquisition cost is quite a bit higher. But just your acquisition cost out of the futures, if you're doing a real market, the real market is Shanghai. And we've always speculated that it would split along these lines, that it would be the East eventually that is setting the delivery market, because you could already have seen during the multitude of decades that they were transferring the wealth via the gold window. This is why this has been a lengthy plan. This has been a lengthy plan. The orchestrators are moving goods and have been stripping the high value Picassos off the American walls and moving them to the castles into the East. They are transitioning with all the good stuff, and it's been going for a long, long time. in the geography. And it's been building up to this crescendo. And now you're getting to the point where alert, money-minded, sound money-minded people are starting to say this is the quickening phase. And I agree, and we are saying that too. But anybody who's been watching the facts for a multitude of decades should not be taken by surprise that we have a casino price and we have a delivery price. And the only price that matters is the delivery price. I was just on the community updates that I do in my own community saying Shanghai price is gold. That's added silver. That's your price. And, you know, Shanghai trades up, casino price stays within an arbitrage percentage. So they still get to run a little bit of a discount on the casino price, which is what they want. And remember, their game is the retail doesn't get to make the money. So they'll do everything to stop retail traders from making the money. The margin increases, flushes out most of the rats and rice of the small people, and keeping the price at probably the largest discount that makes it just not arbitrage value. Don't forget, if you have to buy in and demand delivery in the East, but you want to sell it in, my apologies, in the West and sell it in the East to capture the difference, you will be asked for delivery and asking for delivery in both instances. And you now end up with an unbelievable amount of tonnage in one place that you now have to get to the other side of the planet, which involves specialists, insurance, shipping, and everything else. So my personal opinion is that they're going to maintain that because they're going to throttle the retail traders and the traders that are profiting from that. And it's going to stay in the region approximately where it is. It might even occasionally spike worse, but you'll have to be real quick and you'll have to be very good and you'll have to have connections in the import and the export market to have it make you some money. I don't think it closes in a hurry because it's serving the purpose of preventing retail from getting the full acknowledgement until we go completely mental. Then they all blow off, but I still think you'll have an arbitrage-based frictional difference because it's not in their interest for traders like myself who actually are forced to trade on the Western price, the casino price, but actually sees the Shanghai price as the real price. So just an interesting comment on that. And by the way, also a model of how two-tier price systems, go and research up on the commercial rand and the financial rand. I think that could come for America in the dollars for screwing its own citizens. And just so that people don't know what I'm talking about historically in terms of financial history, South Africa during its sanctions period was desperate for investment because everybody was saying bad country, okay, no more investment. So they actually created a two-tier pricing for external people who sent them dollars. They needed everybody else's forex because now the business, the amount of trade reduced, so they had a shortage of forex reserves. Got paid one rate for conversion to rands, and that was called the financial rand, which was a lot cheaper. So a foreigner could get real big discount for investing. And then they created the commercial rand, which was for the South Africans. And there was completely different exchange rates. And then the local nations, the locals got absolutely destroyed. It's a very cunning technique. And it's very much like the money lenders and the Pharisees to pull this kind of thing. And when you think that Western man bad is the theme on so many levels, I'm predicting that you will get, because of inflation and because of various things, you're going to say, we're going to do this, we're going to try attract investment. Remember, America has huge trade deficits. And if the dollar starts to lose its hegemony, in other words, its power and dominance, and doesn't need to be utilized as much because you can take Chinese yuan, you know it's backed by gold. There's even a vault in your country or in the region that's acceptable for you. There's not hostile forces on there. At any point you could claim it and go and stick it in your own vault, in your reserve bank, in your own country. What was likely to happen is you do a massive transfer of wealth and personal currency destruction by splitting the exchange rate into a commercial dollar and a financial dollar, which sounds very similar, but is a cunning ruse for passing on a massive wealth transfer that punishes your own citizens. And of course, it's also very inflationary, which is exactly what they need when you need a sudden trick to destroy excess debt. Because it's almost like the gold from $20 to $36. It's the inverse of that. You pass a major halvening on your debt valuation, and you pass everyone a haircut without defaulting because you declare it currency. You say, we're going to split our currency. And that's actually is a very cunning way of doing a default on the debt. You make so just let me give you an example. You have all this debt outstanding to foreign nations, and you want to hand them a haircut on it. You say, well, we have the normal dollar, and that's the dollar. But you now go, well, the commercial dollar is worth only a third of the financial dollar. You make all your local citizens carry on the commercial dollar. But you say, if you invest from now on, the financial dollar will be that, and it'll be higher. So you actually punish anyone who's already invested in your country, but you make it more attractive for future investments. And you say, we've had to do this because of, and there's been this, various inflations, volatility in the currency markets. There's clearly a currency for this. You get the narrative spinners, and it's quite a possible ruse that nobody talks about except ourselves in terms of this. And it's a great way of handing a massive haircut on the debt markets without it looking like a default. You just split into two currencies, one which is half or even a third or a fifth. I mean, make it whatever you want, but you're going to pass a massive amount of wealth transfer away from your citizens, and it's going to be a massive impoverishment. And in my reset circle, that's one of the three in our badge, that's exactly what they want to do. That's 100% what they want to do. It's the impoverishment of the West, and to try bring them down to a level of living standard where the trade deficits then get sorted out. And it's part of how you can do a lockstep debasement of your currency, while even saying you didn't do a debasement of your currency. You say, well, the one is cheaper, but you can, people that have the right profile can transact on the other. So there should always be one price for anything. And it's the active gains of the Pharisees to keep the plate spinning when they're running a Ponzi scheme to bifurcate. And this is exactly what we're facing now on a number of levels all the time. You've got a bifurcated silver price. You've got a speculator's casino price. Yes, there's a small amount of delivery that just about gives it some credibility, but it's kept at a discount to the other one only because the arbitrage cost of getting it to the other place that is doing real delivery is so high. So they're already cheating. They're already cheating. You shouldn't have two separate prices. You do the conversion for the Chinese yuan into what it currently is. What that actually is saying is the dollar should be weaker, because essentially the silver price is a silver price in dollars, and it's coming out to a lower number than when I do the Chinese yuan price in silver and I do the conversion on the currency. So you can see the dollar is already, in terms of silver, doing exactly what I'm describing in terms of a commercial and financial rand on that one product, because they're not equating. The price in a perfectly set world, outside of minor frictional costs, I would say, you should be coming to very much the same price. And in actual fact, what you're seeing is the Chinese yuan should actually be considered a more valuable currency. Then if it was a more valuable currency, you would be, then the dollar, you would have to have more dollars on the silver ounces, and you would get bid up to the upper 70s where it should be on the one. So it's already, you're seeing there's a currency element to the difference in prices. Who says it's all about the silver? It's about the silver should be the Shanghai price, and the dollar should be devalued more so that you're at a higher amount on the silver price. So you're starting to, your framing on these things, this is the beginning of a grand unraveling, and two-tier pricing immediately is alarm bells for us, and it's their game and it serves them. Don't think it's by accident. It's their game and it serves them. And look for more of it, not less of it. Don't look for the end of it. Everybody thinks efficient systems will bring it all the way back. That's only if it's allowed to be done so by people that want efficient markets. It's not where we are. We don't have sound money. People don't want efficient markets when it works against them. You're in a perversion, inversion world right now. And people are trying to cover their sins of fiat debasement. So it's a super interesting topic, and we might, you might want to go have a look at that era. Eventually, how it ended, by the way, when sanctions started to unwind on South Africa, they actually brought the two currencies slowly together, and that's all just manipulation. And they brought them back down at a much lower rate, but not as bad as the one, but it came more down. So it ended up closer to the one that was less beneficial for South Africans. And then they merged them. And they slowly, they managed this process over time. Now, that was normalization when you were taking a country that was being re-accepted and you were re-standardizing and simplifying. We're in the opposite process. We're looking to introduce all forms of skullduggery to perpetuate a Ponzi. So, you can replace sanctions on South Africa during the apartheid era with America's debt debasement situation. So I just leave you with an interesting thought for people to think. We've speculated on this a decade or so ago in terms of our gamification of how this whole thing plays out. And a two-tier pricing model 100% serves the control structures of the world.
Yeah, and I think you were one of the people who said earlier this year that you've really got to change your unit of account on how you price things. For example, if I look at US GDP, they talk about how GDP is up. If you price it in gold, it's been on a downtrend since 2001, and it's down this year, no exception here as well.
Recession.
Yeah, exactly. If you price it in gold. If you price the S&P in gold, and
we're going into a full-blown depression, Danny, and the only way you semi-mask that and maybe get away with just calling it another great recession is you are debasing the currency so fast that nominal normies get fooled by number go up. That's nominal normies. Nominal normies. We create sound bites all the time, and we create little stamps with yours truly spitting truths and trying to be funny as well. I hope to be the jester of the grand collapse to keep people laughing during what is actually a tragedy and can be wealth. They need it for their mental health. We must mock and laugh at them. It's the thing they hate most. But the nominal normies are going to be getting all excited. And I get so frustrated when people want to talk about stocks nowadays. It really is, to me, the equivalent of, being on the 13th floor and arguing about what color to paint the apartment when the foundations are imploding and it's the Leaning Tower of Pisa. Everything is layered on top of this. Divide anything, and the answer is there. Divide it in gold ounces, it's going down. Divide in gold ounces, it's going down. You've just done GDP. You're not growing. You're stagnating.
And here's S&P. S&P is down 30% on the year, on 2025.
Yeah, that's atrocious. I mean, listen, you're measuring it against 70%. I don't know what even NVIDIA did this year, but I don't think there'll be many stocks that will be standing at more than 70%. You'll have a few where the statists have crowded out all the money. They've sucked out all the wealth, and they've got the ETFs buying ever more of the bigger, weightiest part of which is another part of the conspiracy, by the way. ETFs and the crowding out and the loss of active management funds. Now, let's get our story straight. Originally, computer buyings by weightings gave far better performance and was cheaper. So I understand how this happened. Active funds were underperforming and overcharging, which is typical of extractor type Wall Street guys. And it goes for City of London and everywhere else. And actually putting a computer on that just reweights on the price changes. Taken to its extreme, however, it becomes a massive problem. And you end up with asset managers like BlackRock that are scooping up all the voting proxies of your money because you're being passive and lazy and never bought the stock and didn't vote at the shareholders meeting, suddenly becoming incredibly powerful because they're your designated representative for a huge population that's all got lazy and is all buying ETFs. You more you buy, the status surveillance grid builders, which is the Mag 7 and everyone else, the more you self-fulfill the doom loop. So there's certain things that come back to the mean, and there's certain mechanisms in markets that actually drive things in the extreme. It's a bit like you're walking a watershed of a mountain. You can fall left or right. You've got one foot on either side. If you take a little bit more steps to the left and you don't keep a foot on the right-hand side of the mountain, you're tumbling all the way down to the extreme into the valley on the left-hand side or the right-hand side, depending which way you went. So markets aren't always self-stabilizing, they can actually be polarizing to the extremes. The ETF concept is one that has actually brought too much power into the asset management, which is why you had the LGBTQ agenda, the DEI, the mining is bad, not enough women, not enough colors, etc., in your board. And these guys have the votes to say, if you don't do this, you're not CEO anymore, because I'm one of your biggest shareholders. And they were proxy bullies on our money. You gave them that power. And what happened is the more people buy in ETFs, the more the money goes into the ones that are going, money go up. So you get a self-fulfilling doom loop. So you have hyper-valued Mag 7 with very unclear returns on this AI and everything that's going down. And you get starvation of capital that disincentivize number 500 in the S&P 500, who keeps underperforming because now he's being crowded out and starved of capital. And that, in a bizarre way, is how silver mines that have been left in the financialization of everything out in the cold during the suppression and repression years. So you need the ETF model to unwind properly for the full flow of capital to start boosting the market caps that silver miners even become big enough to be worthwhile investing in. Because
So
they've
would
been
you-
so starved of capital, they're almost too small now for institutional funds, with a few exceptions. I'm not saying all of them are too small. So you've actually had this entire perversion of the financial system by a proxy. And I've always warned, derivatives are proxies. ETF is a proxy. Owning gold in an ETF is proxy gold. Having a tech ETF with Vanguard, BlackRock, that just computer buys is giving your power of voting on those companies that they are buying to them to abuse for an agenda, which has nothing to do with capitalism and much more to do with Marxism and cultural Marxism, and also to keep the doom loop going for the builders of the surveillance state, which gives them super powerful stocks, prices. They can crush a competitor. They can just buy them out, outbid them. You know, if you start a great company, but it's far more libertarian, it's far more honest, and it's going to do anything in the tech space and give you back your agency and your sovereignty, these guys can come and just offer 50 billion in shares and just take you out and bury you. They don't even need to develop the business any further. They can just kill competition. And having had a father in engineering who dealt a lot with private, often the established incumbent and the primary product does exactly that. Big corporations stifle innovation. Everybody thinks the great innovators are NVIDIA and all of them. They stifle. They are monopolists. They want to dominate. It's Rockefeller capitalism, which isn't capitalism. It's actually Bolshevik communism. It's dominate. We are the final arbitrator in this place. They seek to dominate. That was the model behind Standard Oil. And they did so by bully groups, murdering people, throttling them on transport costs until they owned everything. This is where we're at. We're in a cacocracy. And there's going to be more tricks coming out. We're not reverting to truth. Only the gold and silver price are reverting to truth right now, as even the criminals and the Pharisees themselves recognize the grand bomb that they've made and are sitting on for themselves. So they are having to move also into that, and that's why the big money is moving. By the way, on the margin, by the time they go 50%, they've played all their cards. It'll only be institutional and very big traders. And that won't stop the price. So at what they are now,
cash market, like Eric says.
Yes, it's basically a cash settlement. But in fact, if they get into the 30s, you start arguing for cash. I'll still love it because I've got a flush trading account thanks to being early. By the way, we had a prime at 25.9, which we also announced. Thank you to Eric for being so honorable. But we were actually talking about it at 25.9. That's why we jumped so hard on Brent Johnson, because there we were bull shilling the silver market as just breaking its primer and starting its move. And he was just putting out that post. Sorry to bring him up again, but it was just such irony. And that's why I jumped on him straight away. And I said, mate, we just squeezed through this and all of this has happened. It was just it was a perfect irony because we were taking two totally opposing views. But it actually started at 25.9, then it eventually got to run 30. It started slowly at first, and we've already had a massive increase, and it will go up faster during this year, in my opinion, even faster than you've seen it travel in recent. Do not get shaken off or out of this game. This is your silver lady, as Eric was reminding us. and you don't need to look any further. None of the other girls matter. You married the queen. And that's
what about mining stocks? Given what you said about the ETFs and the fact
brilliant question. So listen to a man speculate who's thrown a few wild cards at you already today, and I'm going to throw another one at you. Here's the big. You've just listened to me explain the ETF conundrum, that they need surveillance finance grid to be built out. You've given them that power by investing in Vanguard, BlackRock ETFs, because the more they buy them, the more they go up. The more they go up, the more they need to reweight and buy them, which is not a balancing loop. It's a polarizing overvaluation on the big, undervaluation on the small. So this rolls into another speculative theory I have for you on the silver miners. There could be a lot of scenarios. So I don't profess to know, but I'm going to throw possibilities at you, because I asked the same questions you just asked. It's a very good quality question. And then what's going on? One, there's a greater risk that's being priced in that some of this might get nationalized. Possibility. America's confiscated gold before. That's one thing. I'm not so sure about that one. I saw Feinstein, the lady, buying Heckler long after we'd suggested it's our favorite in the silver market. It'll move one of the most. It's been one of the best performers of the silver miners this year just past. And she's bought it. And she was on the critical minerals subcommittee that had it designated as a critical mineral. So you've got, that tells me they plan to benefit financially out of it. I don't think they would personally buy the ones if they were going to then subsequently nationalize them. They might if they nationalize them very beneficially and paid everybody at a very high price. So it could be nationalized, and as a shareholder, you could benefit potentially. But they first let it run a whole bunch, and then they overpay for it. Once everybody's like, hell, silver's the most valuable thing in the world, and everyone's overshooting to the upside, the government might come in and overpay and pay out the top. All the private Pharisees that are on insiders get almost overpaid, and they exit, and then it becomes a hyper overvalued asset in the government's budget, and the citizens get once again raped. When in doubt, assume the citizens are the patsy that get raped. It's standard fare. So that could happen, and you would get all the benefits. So then I say, okay, own them. I have calls on them. I have all of that, long-dated leaps on them, which are basically long-dated calls on it. The other option is, coming back to the question, reminding everyone, why are the equities not performing? Here's what I just explained in the ETF and why that was such a great...
Hold on. The gold mining equities are performing, though.
Better.
Yeah. They're outperforming gold by 2x, which is what they ought to do. But silver equities are just...
What? Just for this year, though.
Do what?
Just for this year. How they performed over the last decade. I think you'll find, even if you take a longer-term view, most equities are still lagging. Gold equities have had a better year, particularly the majors. I'm in Agnico, and they've done famously, and I was in that one for a while. But they still generally, if on a longer time frame, are lagging. And here, going back to my ETF discussion, there is an agenda being driven that is the establishment of a surveillance grid. For that, they want the overcrowding of capital. You had this guy Sachs, who's the czar of AI, say, it would be bad for the economy. We'd go in a recession if there was too strong, if there was debt travails or problems a la Oracle's, CDS, and all of these dramas that they're clearly doing non-financial, just do it at any cost. Now, bottomless overdraft is an exclusive of dark state, statist, made in a garage companies. And this is my personal theory. It sounds conspiratorial. Some will go, Francis is a nutter in the comments. Please put it below. Tell me, I don't know what I'm talking about. But all of that, they need those to be the hypervalued. If you start to have a major trend that gets discussed, that is pointing out that that miners are going to become cash hemorrhaging businesses, hugely so, and that their costs are being kept fairly restrained by that same oil price that is not moving up, we referred to earlier in this conversation. You've actually got a bottom line that is quite low, even going down with the oil price. Yes, wages need to go up a little bit, but everybody is being lagged on wages to inflation. But that inflation is absolutely suddenly being recognized, and catch up is happening on the top line, with silver and gold, you've got such a broadening margin that is fattening up something huge. These are turning into cash. If it becomes too proliferated, and this is why I was watching JP Morgan's, 50 stocks for the new year and how they were pushing Exxon and all of this. It's complete propaganda nonsense. I see the gold to oil ratio continuing going up. It's gone from 14 to 78, and I see we're going 80s and beyond. This is a major reversal.
Really quick, Francis, why is Exxon making, it seems like it's breaking out into new highs recently. And then if you look at OIA, companies,
everything rebased to gold.
They're also breaking out too.
Everything rebased to gold. Oil, all of them. Everything you should rebase to gold. I'll check oil. When I last checked, it was around 59. Maybe it's crept back up into the 60s. It might have a little bit. No, it's at 57.4. I'm unimpressed. So, oil isn't breaking out. It's at 57.4.
But the oil service equities are. If you type in OIH, you'll notice that, I mean, they've corrected a little bit recently, but in the aggregate, they've been churning upward.
I've got 2 quarters where it's traded up because the oil price has been pretty flat, slightly down. They're outperforming their oil. They're not outperforming in equities against other categories at all. So I've got it on a 3-month chart. You've got 2 green candles, but they're not overwhelming. I can share the screen on that. I wouldn't get excited by that. And they are pushing like hell to get them. Anyway, I don't want to get taken into those weeds because I've got an important point I want to get to. And this is going to be the key thing, because the question is, why are miners not yet fully being recognized? Let's say particularly silver miners, for example. So that's OH. I don't see that as great. I want to highlight that the 2020 collapse, oil went right back up to 129 and the oil service companies didn't follow. So you've also got to check your timelines. This was oil zero. Then oil went up to 130 up top here. So again, I can draw with lines, but oil was up top here. And the oil services company absolutely lagged and then started coming back down. So if you look beyond these 3 months charts, you look since 2020, they've stayed pretty low relative to before COVID, which was the range up top here. So you're not even got back to the lows of just pre-COVID. So I would argue that if you take anything longer than a short-term chart, they're horrible underperformers. But anyway, back to the topic. So if they are going to, if they allow silver to start being recognized as a major cash hemorrhaging business and mining, you're going to get rotation out of Mag 7 into the miners. And that works exactly against what they want. They want the surveillance grid. They want to bring about a correction. When that corrects, they don't want the money. They don't want retail making money, and they don't want to have to buy in their ETFs, miners as well. It serves them to have the Mag 7 in the sweet spot that the ETF perversion and polarization causes. So if you suddenly have a major bull market in gold and everybody starts singing about it and saying how it's permanent and it's going to stay and this is huge cash profitability, what's going to happen? You're going to start getting a reweighting away from the stocks that are the statist grid delivering companies, which are the most important thing for government. Trump has been the AI guy and the Palantir guy. All of these actors that get put in front of you are rolling out what they largely need and want in terms of how they plan to manage us. And all these corporates that are at the top of the table that get the highest value currencies, you should hate them. And you should hate BlackRock, Vanguard as well too. And why would they allow funds to flow out of that into money, which is starting to make sound money a mainstream discussion? They don't want that at all. So having first blocked the gold market, then they couldn't do it. They blocked the silver market in the capital price. They now dropped to they are retreating. And every time they retreat, they make a stand somewhere. They currently looks to me like there is a complete lack of acknowledgement, which is a blocking force. You can block by just giving no attention. It's a bit like if you want to punish a child, you just ignore him all the time and talk to the other ones. That's essentially mining right now. And that's you as a parent to, the naughty kid. They don't want to give it attention. So that is inherently a block. These things are going to absolutely kill it on earnings coming into 2026. The earnings are going to be ridiculous. And it's going to be like a spike, and then they're going to try to short it back down and whatever. But nobody wants to talk about it. Nobody wants to talk about it. It's like Uncle Fester living in the house is the kiddie fiddler, and nobody wants to deal with it. Why? Because it's truth. It's hard truth. It's ugly truth. They don't want it. They don't want it. They don't want it coming out. So
is it worthwhile investing in mining stocks if that's the case? Even if they are on paper, I mean, solid fundamental stocks.
I think so. But the big thing is taking the risk and certification. So ensure you get named certificates. And they've made that intentionally hard as well. You really have to wrestle and battle. Why? Because it's another derivative proxy scheme. Your trading accounts trade for $5. Nobody makes money on $5. They're just putting digits in a computer for you. You don't own anything. They've got a pool of shares, and they've been rehypothecated many times. Now you start asking for paperwork, and you want it registered in your name. Now you're becoming a pain in the ass, and you have to pay a whole bunch more money. And there's this department, and they send you in the little rat maze that sends you running around for loops until you give up. They don't want that. They don't want it. They're working against it. Everything is a derivative proxy scheme, a bifurcation scheme, a splitting scheme. It's all the tools and tricks of the Pharisees for extend and pretend in their inversion, perversion society. You should learn to recognize their core tricks and stay the hell out. Miners will have to be recognized, just like the silver price finally got recognized after the gold price first got recognized. We called the gold at 2,000, said you're going to the foothills of 4,000 on that, to 3,000, 3,900. And we said at silver 25.9 when the Brent Johnson's famous tweet came out. And again at 30 and 40 all the way up. And your miners will eventually follow because it'll make too much sense. When you start to have a ridiculous PE so low and you're hemorrhaging cash and out beating expectations, but they don't want people to get the attention there just yet, because it takes money away from where they want that money, and they've cornered it right where they are. And they're crowding out the capital into this. AI is the most important thing. Data centers being built everywhere to push your local utility bill up for Americans. You should all feel so privileged and so glad you have this amazing growth. Yet it's like me going and digging holes in the ground and declaring how much growth my country has, and then paying people to fill them up. This is far more devilish of intent. It's all about surveillance grid. It's all about the biometrics. It's all about the CBDC. Your tax money and debt that is being added, that is devaluing your dollar, is being utilized to build your future prison cell in a surveillance digital thing. And this is what people need to realize. So it's not in their interest that the very high valued currency of a stock market valuation and individual equity valuations on Mag 7. We're going into a real problem when they allow that to crash. Then everything goes down, that because it'll be the last to fall. It'll be the last they want to fall. It is already re-rating, by the way, in gold ounces, but in nominal terms, if that starts to fall, then you know that we're in the serious part of the reset. The quickening is over. You're now in it. This is the earthquake. So let me hand back to you.
No, I think that's a great way to close things out here, Francis. Thank you so much for your time here. Always interesting insights. Anything else you'd like to talk about before we take this thing home?
No. I would say to everybody, we've had a great year personally. Our community's had a great year, and you too can do that. I'm assuming if you're a silver and gold stacker, you're not complaining about last year. You need to make it bigger and better and maximize it, and you need to protect it.
Well, here, check this out. So this is on a yearly candlestick, and this is this year's candlestick. Let me make it a little bigger, and let me get the 1 year. Sorry for fiddling around. So here you go. Yeah, so here you go. This is the biggest 1 year candlestick, up 150 some odd percent this year since 1979. And as we can see in previous silver bull markets, as in 72 all the way out until 79 and 80, you had an army of green candlesticks, of green yearly candlesticks. We're just getting this thing started.
Have a year with that 1979 candle all larger.
Mm-hmm.
And it could be next year.
Yeah. So I mean, I hear the argument. I've heard the argument that we had a great year in silver, but as is the case with most of in the markets, it's very unlikely to have two consecutive good years. Well, point of fact, we've actually had that multiple times in the past. We've had it in the 70s, And we've had it in the last great silver bull run in the early 2000s. I mean, we had one red candlestick throughout that period. In the 70s, we had only one as well, and that was barely a red candlestick.
Can I point out one very interesting irony? Both those that are building the surveillance grid, the enemies, and ourselves both need silver.
Mm-hmm.
It's the great irony is they need it for their implants on a far greater level. The solid state batteries, just 20% take up would be 100% of a silver supply. Everything, you know, they want you driving an iPad car made by elongated muskiness. They can lock you in the car, take over, automatic drive, take you straight to the police station, into the basement, literally park your car in the cell. They want all that. They don't want you having independence and an ICE engine that you control. All of those things. They need more silver. And we, in fighting them as part of a monetary metal, need more silver. So silver is the battleground. And both are realizing the other needs it. And both are being self-actualized. So you've actually got black hats and white hats all fighting on the same commodity. And silver is the battleground. It really is the battleground. There's plenty of supply of gold stored in bullion if it were to be used. But that comes in at $4,400 odd, wherever it is now. Silver's got a long, long way. You'll never think of substituting for silver with gold, you know, and it's one of the most transferable. You can't use copper in devices, you know, in conductive. It's not good enough. So this is repricing of silver that you've never seen. You're going to see candles that you've never seen before. Everybody is too bearish on silver. The only thing is you've got a debasing dollar, you've got inflation, you've got monetary demand, and you've got insane industrial demand, specifically here. And they need more of it to keep doing what they want to do. And you need more of it to keep protecting yourself from them. Everybody needs the same thing. And it's called the silver lady. You don't change. Don't let someone sell you Standard Oil shares. Don't let anybody sell you anything else. You sit on the silver lady. I dare and say you ride her all the way home, but you know, you're right where you need to be. You're right where you need to be. So that's an interesting irony. For those of you going forward for this year, there is a judicious method on lower time frames that I've used to exploit. We've blown all our accounts to the high side this year, more than the 140% that was delivered by silver. In my case, I've been quite fortunate, quite substantially. Utilizing our broker partners and HVF method. You need to build wealth during this period. You need to preserve it, and you need to secure as much freedom as is possible in a totalitarian time, particularly for the West. So we'll help you build that wealth. We'll help you with preservation as and when you make it, with reliable partners that we've utilized ourselves, and secure you freedoms. You might need to be more mobile during this period. I know it doesn't come easy if you're a usual stay-at-home guy, you've lived in your home country. Things are going to get ugly for the West. That's our message, but you don't have to commit to leaving just to get wealthier and to maximize these silver gains that are coming for next year that I believe, and gold and platinum as well, which we didn't speak much about. YouTube channel is The Market Sniper. Join us there. There's links in there for booking a call. Follow us on X as well if you like. For notifications. By the way, people are being unsubscribed or not getting the notifications, so following us on X helps, which we will always share the link to a new stream. Thank you so much for having us on. Happy New Year. It's an obstacle course. You can fight and win and come out a much wealthier person with more freedoms, or you can watch this avalanche happen and you can watch it hit your village and take you out. I don't suggest the latter. We need to get going. Things are moving fast. It's going to be a great year for some people and a horrid one for others. And this is the great polarization. And again, it's another example of the citizens of the world being bifurcated by the controlling structures. Have a great year, guys.
Fantastic. Well, thank you so much for coming on, my friend. Always a pleasure having you on. Happy New Year. Hit that like and subscribe, everyone. And type "Go Francis Go" in the comment section. Let me know your thoughts and let me know what you agreed, what you disagreed on, but let me know why you agreed or disagreed. I do, in fact, read all the comments. And if you'd like to add into your gold and silver stack, check out our good partners at the Bullion Standard Pro. Right now, you can get 10% off your first month by using the promo code COSM10 at checkout. The link to that is down below. You effectively get gold and silver at wholesale or near wholesale pricing. So it's important to, cut off on the cost as much as possible when you're buying at these prices. But at the end of the day, I mean, you heard our analysis, so take advantage of it. Link is down below, and check me out on Substack at capitalcosm.substack.com. All right, guys, have a happy new year, and I will catch you all next time. Bye.